Blackstone, the largest private equity firm by assets, more than $200 billion under management. And you may think of the firm for its leveraged buyouts or its hedge fund seeding business, but its profit center last year, the real estate group. Jonathan Gray is in charge of that division. Our colleague, author Jason Kelly, sat down with him for an exclusive interview. In today's private equity report, Gray revealed his fund recently spent $1.5 billion to buy up 10,000 foreclosed homes, making a big bet that residential housing is coming back.
Well, we looked at what was happening in the single-family area over the last couple of years. We were obviously quite active on the commercial side, and we saw some real similarities. The first thing we saw was obviously a lot of distressed homes because of the over-leverage and the bubble that existed. And we saw that there was going to need to be a transfer of these homes from vacant foreclosed state to a different state. And so we showed up and said, wow, we can buy homes at about half the value of where they were in 2006. And there was an opportunity for capital appreciation because when you look out there today, there's so little in the way of new construction. So if you look in housing, new supply of housing is down about 65% from where it was back in 2006. And yet the U.S. population continues to grow. So we felt like there was an opportunity to invest in the sector and buy these homes, and we can talk about this, fix them up, and ultimately lease them out and generate a great return for our investors.
And how big a market are we talking about here?
Well, the U.S. housing market's in the trillions. So to give you a sense of size, we bought today about $1.5 billion worth of homes, about 10,000 homes. When you look at individual markets, they transact in that within weeks, months. This is not a market where we're really having a huge impact in the overall market, but I do think it's having a powerful sort of psychological impact on the market as investors like us come in.
And how long does this opportunity last? How long can you keep doing this?
Well, you know, it's really a function of price. I think when we started, we had an anticipation that it would take a while for prices to recover. And that started to happen more quickly now because investors are recognizing that home prices are really at historic lows. Multifamily rents are much higher. Affordability is very low. This really is the right time to be buying. However, other people are seeing that. Prices are starting to move up. Other institutional players are coming in. Consumers are recognizing that. And as all that happens, prices move up. And for investors like ourselves, we have to be sort of watching that carefully, not on a macro basis, but on a market-by-market basis.
And how do you build the infrastructure that's necessary to not only buy the houses, but then fix them and make them available to this population that needs them?
So that's really the biggest issue, and that's the question we get from most investors. They're comfortable that the basis in the asset is good and that there should be a recovery in prices. What we did is we partnered with the largest third-party multifamily manager in the country, and we're building out a whole company called Invitation Homes. And we're hiring thousands of people across multiple markets, and our job's to renovate the homes, lease them out, and then maintain them. And really do what's done in the apartment business on a national basis, which is give professional service to tenants. That's something I think we can do, but you have to invest an enormous amount of money, time, energy to build the infrastructure, and I think that's the biggest barrier to entry for other competitors here.
As an investor, you obviously not only have to buy, but you eventually have to sell to get money back to your own investors. How do you do that in this situation?
Well, I'd say two ways. We don't know with certainty because this hasn't been done before. But one area is the public markets, and there are a couple of potential public companies going out there to raise capital. There is a very large market for multifamily REITs, manufactured housing REITs, other residential owners who lease property. We don't see any reason why you wouldn't see the same thing in the single-family area where we built a national company, and that company delivers great returns to shareholders through dividends and capital appreciation. So that's one model that we think is pretty compelling. The second area, if the public markets don't exist, is the liquidity that exists in private markets for homes. So if we buy these homes, we lease them up, there's all sorts of investors out there and individual homeowners who could be buyers. And I would add, I think what we're doing here is pretty positive for the economy overall because we're deploying a lot of capital, we're hiring a lot of people, we're taking a lot of troubled houses off neighborhoods and fixing them up, and we're taking that stock out that's really depressing prices, all this distressed inventory. So I think all of it is sort of positive for the economy overall, but clearly we think a good investment strategy for our investors.
Is it getting competitive?
It's definitely getting more competitive, and that's something we're watching very carefully. We've talked to our investors about that. When prices we think have moved up too much, that's when it'll be a sign for us that maybe this market's gotten too mature. Right now, it still feels like a good time. On average, we're buying, we still think, 30 or 40% below physical replacement costs. But home prices can move quickly. In Phoenix, for instance, home prices went up 20% in the last year, let's say. And so when that starts to happen, you'll have to moderate which markets you go into or just stop entirely. And that's something we're watching pretty closely.
You manage the biggest real estate opportunity fund in the world, just raised $13.3 billion. You see everything. Over the next year, what's the biggest surprise in real estate?
You know, I would say, going back to this residential comment, I think the recovery in house prices could surprise people. They've just gotten beaten down so much. We're not building enough to keep up with the population growth. Affordability is there, and I think as homeowners get a little bit of confidence, which they've been lacking because of the economic environment, a lot of it makes sense, but I think it's gotten so compelling, and you're now seeing signs of housing price appreciation. I think that will have more people lean in towards buying homes. That'll lead to faster home price appreciation, which will be good, obviously, for this investment strategy, but also be good for the economy at large.